threadbare clothing, and she's delaying gratification right to the end and probably has 4,000 A shares. It's just these second and third generation types that are buying all the jewelry.
It's interesting if you think about, we'll take it to a broader point, but if you think of a 30-year government bond paying 3%, and you allow for, as an individual, paying some taxes on the 3% you'll receive, and you'll have the Federal Reserve Board saying that their objective is to have 2% inflation, you'll really see that delayed gratification, if you own a long government bond, is that you get to go to Disneyland and ride the same number of rides 30 years from now that you would if you did it now. The low interest rates for people who invest in fixed dollar investments really mean that you really aren't going to eat steak later on if you eat hamburgers now, which is what I used to preach to my wife and children and anybody else that would listen many years ago. I don't necessarily think that for all families in all circumstances that saving money is necessarily the best thing to do in life. I mean, if you really tell your kids they can, whatever it may be, they never go to the movies or will never go to Disneyland or something of the sort, because if I save this money 30 years from now, we'll be able to stay a week instead of 2 days. I think there's a lot to be said for doing things that bring you and your family enjoyment rather than trying to save every dime. So I advise delayed gratification is not necessarily an unqualified course of action under all circumstances. I always believed in spending 2 or 3 cents out of every dollar I earned, saving the rest. But I've always had everything I wanted. I mean, one thing you should understand, if you aren't happy having $50,000 or $100,000, you're not going to be happy if you have 50 million or 100 million. I mean, a certain amount of money does make you feel, and those feel around you feel better, just in terms of being more secure in some cases. But loads and loads of money. I've probably known as many rich people as just about anybody, and I don't think they're happier because they get super rich. I think they are happier when they don't have to worry about money. But you don't see a correlation between happiness and money beyond a certain place. So don't go overboard on delayed gratification. Andrew?
This question comes from a shareholder of yours for more than 20 years who asked to remain anonymous, but wanted me to start by saying, Warren and Charlie, I want to preface this question by saying it comes from a place of love for both of you and the beautiful painting you've drawn for us in the form of Berkshire.
But
now, please update us on succession planning. And as you think about succession, would you ever consider having Greg and Ajit join you on stage at future annual meetings and allow us to ask questions of them and Ted and Todd as well, so we can get a better sense of their thinking?
That's probably a pretty good idea, and we've talked about it. We have Greg and Ajit here, and any questions that anybody wants to direct on them, it's very easy to move them over. So we thought about having 4 of us up here. And this format is not set in stone at all. Because I can tell you that Actually, the truth is, Charlie and I are afraid of looking bad. Those guys are better than we are. You could not have two better operating managers than Greg and Ajit. I mean, it's just fantastic what they accomplished. They know the business is better. They work harder by far, and you were absolutely invited to ask questions that to be directed over to them at this meeting. I don't think, this format will not be around forever, and if it's better to get them up on the stage, we'll be happy to do it. Ted and Todd, they're basically not going to answer investment questions. We regard investment decisions as proprietary, basically. They belong to Berkshire. And we are not an investment advisory organization. So that is counter to the interests of Berkshire for them to be talking about securities they own. It's a counter to the interest of Berkshire for Charlie or me to be doing it. We've done better because we don't publish every day what we're buying and selling. I mean, if somebody's working on a new product at Apple, or somebody's working on a new drug, or they're assembling property or something of the sort, they do not go out and tell everybody in the world exactly what they're doing every day. And we're trying to generate ideas and investment, and we do not believe in telling the world what we're doing every day, except to the extent that we're legally required. But it's a good idea. Charlie?
Well, one of the reasons we have trouble with these questions is because Berkshire is so very peculiar. There's only one thing like it. We have a different kind of unbureaucratic way of making decisions. There aren't any people in headquarters. We don't have endless committees deliberating forever and making bad decisions. We're radically different, and it's awkward being so different. But I don't want to be like everybody else because this has worked better. So I think you're just going to have to endure us.
We do think that it's a huge corporate asset which may only surface very occasionally, and depending very much on how the world is around us, but to be the one place, I think, in the world almost where somebody can call on a Saturday morning and meet on Sunday morning and have a $10 billion commitment, and nobody in the world doubts whether that commitment will be upheld, and it's not subject to any kind of welching on the part of the company that's doing it. It's got nothing involved other than Berkshire's word, and that's an asset that every now and then will be worth a lot of money to Berkshire, and I don't really think it will be subject to competition. And Ted and Todd, in particular, are an additional pipeline, and have proven to be an additional pipeline in terms of facilitating the exercise of that ability. I mean, things come in through them that for one reason or another I might not hear about otherwise. So they have expanded our universe. In the markets we've had in recent years, that hasn't been important. I can see periods where they would be enormously valuable. Just take the question that was raised by the fellow from Winnipeg about weak covenants in bonds. I mean, we could have a situation, who knows when, who knows where, or who knows whether, but we could have a situation where there could be massive defaults in the junk bond type market. We've had those a couple times and we made a fair amount of money off of them. But Ted and Todd would multiply our effectiveness in a big way if such a period comes along, or some other types of periods come along. They're very, very, very useful to Berkshire. The call happened to come in on Friday from Brian Moynihan, of CEO of Bank of America, and has done an incredible job. But we have a better chance of getting more calls and having them properly filtered and everything, appropriately filtered, the next time conditions get chaotic than we did last time, and that's important. Charlie?
Well, I do think it's true that if the world goes to hell in a handbasket, that you people will be in the right company. We've got a lot of cash and we know how to behave well in a panic. And if the world doesn't go to hell, are things so bad now? And I also want to report that your vice chairman is getting new social distinction. I've been invited during this gathering to go to a happy hour put on by the Bitcoin people. And I tried to figure out what the Bitcoin people do in their happy hour, and I finally figured it out. They celebrate the life and work of Judas Iscariot.
Is your invitation still good? Well, Bitcoin, actually, on my honeymoon in 1952, my bride, 19, and I, 21, stopped in Las Vegas. My Aunt Alice gave me the car and said, have a good time, and we went west. So we stopped in the Flamingo, and I looked around, and I saw all of these well-dressed, they dressed better in those days, well-dressed people who had come, in some cases, thousands of miles away. And this was before jets, so transportation wasn't as good. And they came to do something that every damn one of them knew was mathematically dumb. And I told Susie, I said, we are going to make a lot of money. I mean, imagine people going to stick money on some roulette number with a 0 and a 00 there and knowing the percent. They all could do it, and they just do it. And I have to say, Bitcoin has rejuvenated that feeling in me. Okay, Greg?
Warren and Charlie, while I understand Berkshire's need to trim its stake in Wells Fargo and any other banks you hold each year in order to bring Berkshire's ownership stake below the 10% threshold required by the Federal Reserve for bank holdings, given the ongoing share repurchase activity that's taking place in the industry. I was kind of surprised, though, to see you move to trim all of your holdings where possible on a regular basis to eliminate the regulatory requirements that come with ownership levels above 10%, which in my view limits the investable universe that Berkshire, or at least Warren, can meaningfully invest in longer term, given that Warren manages a large chunk of Berkshire's $200 billion equity portfolio. Could you elaborate more on the regulatory impact for Berkshire of holding more than 10% of any company's stock, as well as how you feel about the Fed's recent proposal to allow investors like Berkshire to own up to 25% of the shares of a bank without triggering more restrictive rules and oversight? Yeah. Basically, if that proposal were to come to fruition, would you be willing to forego that 10% threshold self-imposed that you've done and put money to work in names that you're already fairly comfortable with?
Yeah, the 10%, there's a couple of reasons.
That's the right answer, yeah.
Yeah. We will, there's two factors beyond, in the case of banks, there's the Federal Reserve requirement there. But many people probably might not know about this, but if you own over 10% of a security, common stock, and you sell it within 6 months at a profit, you give the money over to the company. It's a sword swing profit that you give them, and you match any sale against your lowest purchase. And I think if you sell it and then buy it within 6 months, I'm not as positive about that because I haven't really read the rule for a lot of years. But I think if you sell and then buy within 6 months and the purchase is below the price at which you made the sale, you owe the money to the company. There used to be lawyers that would scan that monthly SEC report that I used to get 30 or 40 years ago. They would scan it to find people that inadvertently had broken that rule, and they would get paid a fee for recovering it for the company. So it restricts significantly your ability to reverse a position or change your mind or something of the sort. Secondly, I think you have to report within 2 or 3 business days every purchase you make once you're in that over 10% factor. So you're advertising to the world, and the world tends to follow us some. So it has a huge execution cost attached to it. Nevertheless, and those are both significant minuses, and they're both things that people generally don't think about. We did go over recently, for example, in Delta Airlines. That was actually an accident, but I don't mind the fact at all that we did. And if the Federal Reserve changes its approach, we won't have to trim down below that. We don't want to become a bank holding company, and we don't want to. We went in many years ago and got permission with Wells, but then our permission expired, and we went in again a couple of years ago, and we spent a year or so, and there were just a million questions that Wells got asked about us and so on. So it's been a deterrent. It'll be less of a deterrent in the future, but it does have those two. The short swing thing is less onerous to us than it would be to most people who buy and sell stocks, because we don't really think in terms of doing much with them.
But if we didn't have all these damn rules, we would cheerfully buy more, wouldn't we?
Sure. Yeah. Well, anytime we buy it, we do it cheerfully. But we will. You'll probably see us at more than 10% in more things. And if the Fed should change its rules, there will be companies where we drift up over 10% simply because they're repurchasing their shares. That's been the case with Wells, and it's been the case with an airline or two in the last year or so. If we like 9.5% of a company, we'd like 15% better. And you may see us behave a little differently on that in the future.
Well, one more awkward disadvantage of being extremely rich.
Yeah. And it really is. I mean, yeah, and people following you. I mean, the followers' problem can be a real problem. Okay, station 6.
Hi, I'm Jeff Malloy from San Francisco, and this is my first shareholders meeting. Mr. Buffett and Mr. Munger, I'm 27 years old and aspire to be a great money manager like you two one day. I am considering starting my own investment fund, but I also recognize that I am young and have a lot to learn. My question to both of you is, how did you know you were ready to manage other people's money, and what general advice would you give to someone in my shoes? Thank you.
Well, it's a very interesting question because I've faced that, and I sold securities for a while. But in May of 1956, I had a number of members of my family. I'd come back from New York, and they wanted me to help them out with stocks as I had earlier before I'd taken a job in New York. And I said I did not want to get in the stock sales business, but I wanted to. I enjoyed investing. I was glad to figure out a way to do it, which I did through a partnership form. But I would not have done that if I thought there was any chance, really, that I would lose them money. And what I was worried about was not how I would behave, but how they would behave. Because I needed people who were in sync with me. So when we sat down for dinner in May of 1956 with 7 people who either were related to me or one was a roommate in college and his mother, and I showed them the partnership agreement, and I said, you don't need to read this. There's no way that I'm doing anything in the agreement that there's any way that, you don't need a lawyer to read or anything of the sort. But I said, here are the ground rules as to what I think I can do and how I want to be judged. And if you're in sync with me, I want to manage your money, because then I won't worry about the fact that you will panic if the market goes down or somebody tells you something different. So we have to be on the same page. And if we're on the same page, then I'm not worried about managing your money. And if we aren't on the same page, I don't want to manage your money, because you may be disappointed when I think that things are even better to be investing and so on. So I don't think you want to manage other people's money until you have a vehicle and can reach the kind of people that will be in sync with you. I think you ought to have your own ground rules as to what your expectations are, when they should send you roses and when they should throw bricks at you, and you want to be on the same. And that's one reason we didn't have a single institution in the partnership, because institutions meant committees, and committees meant that
you had some aunts that trusted you.
What's that?
You had some aunts who trusted you.
Yeah, well, and a father-in-law that gave me everything he had in the world, and I didn't mind taking everything he had in the world, as long as he would stick with me and wouldn't get panicked by headlines and that sort of thing. And so it's enormously important that you don't take people that have expectations of you that you can't meet. And that means you turn down a lot of people. It means you probably start very small and you get an audited record. And when you've got the confidence where if your own parents came to you and they were going to give you all their money and you were going to invest for them, you've got the kind of confidence that you'll say, I may not get the best record, but I'll be sure that you get a decent record over time. That's when you're ready to go on it.
Let me tell you a story that I tell young lawyers who frequently come to me and saying, how can I quit practicing law and become a billionaire instead? And so I say, well, it reminds me of a story they told about Mozart. A young man came to him and he said, I want to compose symphonies and I want to talk to you about that. And Mozart said, how old are you? And the man said, 22. And Mozart said, you're too young to do symphonies. And the guy says, but you were writing symphonies when you were 10 years old. He says, yes, but I wasn't running around asking other people how to do it.
Carol, we wish you well. But and actually we really do, because the fact you asked that sort of a question is to some extent indicative of the fact that you got the right attitude going in.
It isn't that easy to be a great investor. I don't think we've quite made it.
This question is from Franz Tromberger of Austria and his son Leon, who are both Berkshire shareholders. And it's interesting to me that in the years we've been doing this, nobody has ever asked this question, as far as I know. Their question is, Mr. Buffett, I believe it is correct that in its SEC filings, that is the Securities and Exchange Commission, Berkshire does not have to give information about foreign stocks it holds. Assuming we hold foreign stocks, could you please tell us what our 5 largest positions are?
Another fellow wants investment information. We really aren't in the investment information business. We disclose what we have to disclose, but we could set up an investment advisory firm and probably take in a lot of money, but we haven't done it, and we aren't giving away what belongs to our shareholders for nothing. But he's correct that I'm 99% sure he's correct, and Mark Hamburg can correct me, but from our office. But we do not have to report foreign stocks, and we do have in certain important countries, there's lower thresholds at which we have to report our holdings as a percentage of the company's stock outstanding. There's lower thresholds than there are in the United States. So in a sense, in certain stocks, I think when we bought Munich Re stock or bought Tesco stock, or there's certain stocks we've had to report at before we would have had to report in the United States. But we will never unnecessarily advise if we plan to buy some land someplace, if we plan to develop a business. We are not about giving business information that's proprietary to Berkshire. We don't give it unless we're required by law, and he is correct that I'm virtually certain that we do not have to report our foreign stocks to on the SEC filings. And he'll have to find his own holdings in Austria. I think his Mozart story may have encouraged that particular question from Austria, what stocks we're going to own in Austria. Okay, Charlie, do you have any comments?
No.
No, I didn't think you would. Johnny?
Precision Castparts pre-tax profit margins, while perfectly fine relative to American industry as a whole, continue to be almost 10 percentage points below where they were in the years preceding the acquisition, and I'm guessing they're lower than contemplated when the purchase price was determined. The annual report hints that unplanned shutdowns, the learning curve on new plane models, and a shift of oil and gas capacity to aerospace might all be temporarily depressing margins, but it's unclear what a reasonable long-term margin expectation is for this unit. Now, I know you won't want to issue a specific margin target or forecast, but I do have a question that I hope you can answer. Is the downward trend in earnings since 2015 mostly due to these transitory items, or have the competitive structure of the industry and Precision's relationship with its customers changed to the point that meaningful increases from current margin levels are probably unlikely?
Yeah. Your prelude is quite correct. I mean, they are below what we projected a few years ago, and my expectation, but I would have told you this a year ago, and they have improved somewhat. My expectation is based on the contracts we have and the fact that the initial years in anything in the aircraft industry, for example, tend to be less profitable as you go further down the learning curve and the volume curve. Tend to be lower in the near term. My expectation is that the earnings of Precision will improve fairly significantly. And I think I mentioned maybe to you last year, in those earnings, there is about $400 million a year of purchase amortization, which are economic earnings in my viewpoint. But even including that $400 million a year, which they would be reporting if they were independent, and we don't report because we bought them and there's a purchase amortization charge. Even without that, they are below what I would anticipate by a fair margin within a year or two. That's the present expectation on my part. Charlie?
No, I don't have any.
You'll have that question for me next year. I think I'll be giving you a different answer. Okay, station 7.
Good morning, Mr. Buffett, Mr. Munger. My name is JC. I am 11 years old and I come from China. This is my second year at the meeting. Mr. Munger, it's great to see you again after the Daily Journal meeting in February. Mr. Buffett, you mentioned that the older you get, the more you understood about human nature. Could you elaborate more about what you've learned? And how can the differences of human nature help you make a better investment? I would also like Mr. Munger to comment on that, please. Thank you very much.
Well, you should wait for Charlie's answer because he's even older. He can tell you more about being old than I can even. It's absolutely true that virtually any yardstick you use, I'm going downhill. And if I would take a SAT test now and you could compare it to a score of when I was in my early 20s, I think it'd be quite embarrassing. And it's certainly, Charlie and I can give you a lot of examples, and there's others we won't tell you, about how things decline as you get older. But I would say this: it's absolutely true, in my view, that you can and should understand human behavior better as you do get older. You just have more experience with it, and I don't think you can read. Charlie and I read every book we could on every subject we were interested in, when we were very young, and we learned an enormous amount just from studying the lives of other people. But I don't think you can really. I don't think you can get to be an expert on human behavior at all by reading books, no matter what your IQ is, no matter who the teacher is. And I think that you really do learn a lot about human behavior. Sometimes you have to learn it by having multiple experiences. I actually think despite all the other shortcomings, and I can't do mental arithmetic as fast as I used to, and I can't read as fast as I used to, but I do think that I know a lot more about human behavior than I did when I was 25 or 30.
If you want one mantra, it comes from a Chinese gentleman who just died, Lee Kuan Yew, who was the greatest nation builder probably that ever lived in the history of the world. And he said one thing over and over and over again all his life: figure out what works and do it. You just go at life with that simple philosophy from your own national group, you will find it works wonderfully well. Figure out what works and do it.
And figuring out what works means figuring out how other people behave.
Of course.
And Charlie and I have seen the extremes in human behavior and in so many unexpected ways. And
now we get it every night. Yeah. Extremes of human behavior.
Yeah.
All we got to do is turn on the television.
Yeah. I'm glad he used that example. Okay, Becky?
Warren, you mentioned in response to an earlier question that Ajit and Greg are both here to answer questions, and so I thought I'd ask this question that comes from Will in Seattle. He says his question is for Mr. Ajit Jain and Mr. Warren Buffett. You have said that you communicate regularly about unconventional insurance contracts that expose the company to extremely unlikely but highly costly events. I'm curious about how you think about and safely price these unconventional insurance contracts. What analyses and mental checks do you run through your head to make sure that Berkshire Hathaway will profit without being unduly exposed to catastrophic risk? Furthermore, Mr. Buffett, would you want a future CEO to continue a similarly close collaboration with the chief underwriter?
We will get a microphone to Ajit and spotlight in just a second. And There he is. Ajit, why don't you answer first if you'd like to?
Hi. Obviously, the starting point, I mean, these situations where there's not enough risk, not enough data to hang our hat on, it's more of an art than a science. We start off with as much science as we can use, looking at historical data that relates to the risk in particular, or something that comes close to relating to the risk that we're looking at. And then beyond that, if there's not enough historical data we can look at, then clearly we have to make a judgment in terms of what are the odds of something like that happening. We absolutely, in situations like that, we absolutely make sure we cap our exposure, so that if something bad happens or if we got something wrong, we absolutely know that how much money we can lose and whether we can absorb that loss without much pain to the income statement or the balance sheet. In terms of art, it's a difficult situation. More often than not, it's impossible to have a point of view, and we end up passing on it. But every now and then, we think we can get a price where the subjective odds we have of something like that happening has a significant margin of safety in it. So we feel it's a risk that's worth taking. And then finally, the absolute acid test is I pick up the phone and call Warren. Warren, here's the deal. What do you think? Okay. Your turn, Warren.
Okay.
It's not easy, and you wouldn't want just anybody doing it for you.
No. In fact, the only one I would want doing it for us on the kind of things we have sometimes received is Ajit. I mean, it's that simple. There isn't anybody like him. And as Ajit said, we'll look at a worst case, but we are willing, if we like the odds, and like you say, there's no way to look these up. We can tell you how many, or how many 6.0 or greater earthquakes have happened in the last 100 years in Alaska or California or so on. And there's a lot of things you can look up figures on. Now, sometimes those are useful and sometimes they aren't, but there's a lot where you can get a lot of data. And then there's others that, after 9/11, was that going to be the first of several other attacks that were going to happen very quickly? There were planes flying that couldn't land in Hong Kong, as I remember. I think it was Cathay Pacific. Couldn't land in Hong Kong the following Monday unless they had a big liability coverage placed with somebody. I mean, the world had to go on. The people that held mortgages on the Sears Tower and all of a sudden wanted a coverage, or I think that actually was one, but they were just pouring in people that hadn't been worried about something a week earlier, and now they were worried about things involving huge sums. And there were really only a couple people in the world that would even listen and had the capacity to take on a lot of the deals we were proposed. And there's no book to look up. So there's a big element of judgment. Ajit and I mean, Ajit's 100 times better at this than I am, but we do tend to think alike on this sort of thing. You don't want to think too much alike, but we think alike. I've got a willingness to lose a lot of money. And virtually every insurance company, if they get up to higher limits, they've got treaties in place and they can only take this much. So the world was paralyzed on that. We don't get those now, obviously, but we do occasionally get inquiries about doing things that really nobody else in the world can do. It's a little like our investment situation, only transferred over to insurance. We don't build the business around it, but we are ready when the time comes. And Ajit is an asset that no other company in the world has. And we work him. And we actually enjoy a lot talking to each other about these kind of risks because he'll ask me to think about what the price should be, and he'll think about, we don't tell each other ahead of time, and then I'll name it, and then he'll say, have you lost your mind, Warren? You know, and then he'll point something out to me that I've overlooked. And it's a lot of fun, and it's made us a lot of money. And the shareholders of Berkshire Hathaway are extraordinarily, you can't hire people like Ajit. I mean, you know, you get them once in a lifetime. Charlie?
I don't think we helped him very much. It's really difficult.
There will be a time when, I mean, I probably won't be around then, but there will be a time occasionally, just like in financial markets, when things are happening in the insurance world, and basically Berkshire will be the only one, virtually the only one people turn to.
But in the past, Ajit, talking to you, has added more than $50 billion to the balance sheet of Berkshire by making these oddball calls.
And if he hadn't talked to me, it'd be probably $49.9 billion. Yeah. But you don't want to try. Don't try this at home. I mean,
that doesn't mean it's easy.
No, and it's not very teachable. I mean,
no, it isn't very teachable.
No,
you're right.
No, it is not. It's not something that Berkshire has some secret formula someplace for. It basically is a very unusual talent with the Ajit, and
we're not holding anything back. It's hard.
Okay, Jay.
This question is on Berkshire's relationship with 3G Capital. Kraft Heinz's recent challenges have raised questions about whether Berkshire's partnership with 3G has become a weakness for Berkshire. Warren, what are your thoughts on this? And would Berkshire be open to partnering again with 3G in a major acquisition?
Yeah, they are our partners, and we joined them at a one-page agreement, which I haven't even actually ever reread. I mean, it's a Georgie Paulo is a good friend of mine. I think he's a marvelous human being, and I'm pleased we made that. We are partners. It's conceivable that something would come up. They have more of a taste for leverage than we do, and they probably have more of a taste for paying up, but they also are, in certain types of situations, they'd be way better operators than we would. I mean, they go into situations that need improvement, and they have improved them, but I think both they and we, I know we, did underestimate not what the consumer is doing so much, but what the retailer is. And at See's Candy, we sell directly to the consumer, but at Kraft Heinz, they're intermediaries. And those intermediaries are trying to make money. We're trying to make money, and the brand is our protection against the intermediaries making all the money. Costco tried to drop Coca-Cola back in, I think, 2008, and you can't drop Coca-Cola, and not disappoint a lot of customers. Snickers bars are the number one candy that Mars makes them, and they've been number one, I think, for 30 or 40 years. And if you walk into a drugstore and the guy says, I've got the Snickers is 75 cents or whatever it might be, and I've got this special little bar we make, my wife and I make in the back of the store, and it's only 50 cents and it's just as good, you don't buy it. When you're at some other place, the next time you buy the Snickers bar. So brands can be enormously valuable But many of the brands are dependent, most of them. Geico is not. Geico goes directly to the consumer. If we save the consumer money on insurance, they're going to buy it from us. And our brand, we'll spend well over $1.5 billion on advertising this year. And you think, my God, we started this in 1936, and we were saying the same thing then about saving 15% in 15 minutes or something. It was not exactly the same, but that brand is huge, and we have to come through on the promise we give, which is to save people significant money on insurance, a great many people. That brand is huge, and we're dealing directly with the consumer. And when you're selling Kool-Aid or ketchup or Heinz 57 sauce or something, you are going through a channel, and they would, as the phrase was used earlier today, our gross margin is their opportunity, and we think that the ultimate consumer is going to force them to have our product, and that we will get the gross margin. And that fight, that tension, has increased in the last 5 years, and I think it's likely to increase in the next 5 or 10 years. And Charlie is a director of a company that has caused me to think a lot about that subject. Charlie?
Well, what I think is interesting about the 3G situation, there's a long series of transactions that worked very well. And finally, there was one transaction at the end that didn't work so well. That is a very normal outcome of success in a big place with a lot of young men who want to get rich quick. And it just happens again and again. And you want to be careful. It's so much easier to take the good ideas and push them to wretched excess.
Yeah, no idea is good at any price, and the price element is probably something that we worried more about generally than our partners. But we are their partners in Kraft Heinz, and it's not at all inconceivable that we could be partners in some other transaction in the future. Okay, station 8.
Hello, Warren and Charlie. Consumer tastes are changing. I think if we asked how many people here in the arena have eaten Velveeta cheese in the last year or so, there'd be only a small handful, maybe more for Jell-O. 3G's playbook of cutting R&D looks to have stifled new product development amidst changing preferences. So here's my question. Why continue to hold when the moat appears to be dry, or do you think it is filling back up?
Well, I don't think the problem was that they cut research or something. I think the problem was they paid a little too much for the last acquisition.
Yeah, Jell-O, I can't give you the exact figure. There's certain brands that may be declining 2% a year, 3% a year in unit sales, and there's others that are growing 1 or 2%. There's not dramatic changes taking place at all. I mean, Kraft Heinz is earning more money than Kraft and Heinz were earning 6 or 7 years ago. I mean, and the products are being used in a huge way. Now, it's true that there are always trends going to some degree, but they have not fallen apart remotely. And they have widened the margin somewhat, but it is tougher in terms of the margin and the price negotiations probably to go through to the actual consumer. That's become a somewhat tougher passageway for all food companies than it was 10 years ago. It's still a terrific business. I mean, you mentioned Jell-O or Velveeta. Charlie works at my grandfather's grocery store in 1940. I worked there in 41. And if they were buying those products then, they buy the products now the margins are still very good. They earn terrific returns on invested capital, but we paid too much in the case of Kraft. You can pay too much for a growing brand. I mean, you can pay way too much for a growing brand. Probably easier to be sucked into that. So I basically don't worry about the brands. Certain of them are very strong, and certain of them are declining a bit. But that was the case 10 years ago. It'll be the case 10 years from now. But there's nothing dramatic happening in that. Okay, we'll take one more and then we'll break for lunch. Andrew.
Thank you, Warren. Question on technology and the company's biggest holding now. Given that Apple is now our largest holding, tell us more about your thinking. What do you think about the regulatory challenges the company faces, for example? Spotify has filed a complaint against Apple in Europe on antitrust grounds. Elizabeth Warren has proposed ending Apple's control over the App Store, which would impact the company's strategy to increase its services businesses. Are these criticisms fair?
Well, again, I will tell you that all of the points you've made, I'm aware of, and I like our Apple holdings very much. I mean, it is our largest holdings. And actually, what hurts in the case of Apple is that the stock has gone up. And we'd much rather have the stock. And I'm not proposing anything be done about it, but we'd much rather have the stock at a lower price so we could buy more stock. And importantly, if Apple, I think they authorized another $75 billion the other day, but let's say they're going to spend $100 billion in buying in their stock in the next 3 years. You know, it's very simple. If they buy it at 200, they're going to get 500 million shares. They've got 4,600 million out now, and so they'll end up with 4.1 billion under that circumstance. If they're buying it at 150, they'd buy in 667 million shares. And instead of owning what we would own the first case, the divisor would be less than 4 billion, and we'd own a greater percentage of it. So in effect, a major portion of earnings, at least possibly, it's at least been authorized, will be spent in terms of increasing our ownership without us paying out a dime, which I love for a business, a wonderful business. And the recent development, when the stock has moved up substantially, actually hurts Berkshire over time. We'll still do, in my opinion, we'll do fine, but we're not going to get into, we're not going to dissect our expectations about Apple, you know, for people who may be buying it against us tomorrow or something. So we don't give away investment advice on that for nothing. But we have all the things you've mentioned. Obviously, we know about. We know some. We've got a whole bunch of other variables that we crank into it, and we like the fact that it's our largest holding. Charlie?
Well, in my family, the people who have Apple phones, it's the last thing they'll give up.
Not a bad item to have. And the other thing we won't give up is lunch, and we'll now adjourn and we'll reconvene at 1 o'clock or thereabouts.